Introduction to cost of capital and capital structure. Every business, whether a startup or a multinational corporation, requires capital to fund its operations, expansion, and innovation. The cost of capital represents the price a company pays to acquire this capital, while the capital structure is the mix of debt and equity used to finance its operations. Understanding how to calculate, analyze, and optimize both is critical for making informed financing, investing, and valuation decisions. Think of cost of capital as the minimum return a business must earn to satisfy its investors and lenders. Understanding the cost of capital. The cost of capital is the return expected by those who provide funds to a business. It includes cost of debt, KD, interest paid on borrowed funds, cost of equity, KE, return expected by shareholders for their investment risk, weighted average cost of capital, WACC, the average of both costs, weighted by their share in the capital structure. A. Cost of debt, KD. It is the effective interest rate the company pays on its debt. Formula: after-tax cost of debt equals interest rate times 1 minus tax rate. Example: a company borrows 10 million naira at 15% interest with a 30% tax rate, equals 15% times 1 minus 30%, 1 minus 0.3 equals 10.5%. This reflects the tax shield benefit from debt interest deductions. B. Cost of equity, KE. It is the return shareholders expect for investing in the company. Methods to estimate K. Dividend discount model, DDM. Key equals dividend per share divided by market price, plus growth rate capital asset pricing model, CAPM. Key: RF plus beta times open parenthesis RM minus RF close parenthesis, where RF equals risk-free rate. Beta equals beta, stock volatility. RM equals market return. Example, CAPM. RF equals 10%, beta equals 1.2, RM equals 18%, key equals 10%, plus 1.2 times 18% minus 10% equals 19.6% C. Weighted average cost of capital, WACC. WACC equals EV times KE plus DV times KD times 1 minus T, where E equals market value of equity, D equals market value of debt, V equals E plus D, T equals tax rate. Importance of WACC used in investment appraisal, e.g., NPV benchmark for evaluating new projects. Reflects opportunity cost of capital. Understanding capital structure. Capital structure refers to the proportion of debt and equity a company uses to finance operations and growth. A. Components of capital structure equity. Capital issued shares, common and preferred, retained earnings, debt capital, loans, bonds, debentures, short-term and long-term borrowings. B. Capital structure theories. Modigliani-Miller, M&M. Theory: no taxes. Capital structure is irrelevant in a perfect market. M&M theory: with taxes. Debt increases firm value due to tax shields. Trade-off theory: balances tax benefits of debt with bankruptcy risks. Pecking order theory: firms prefer internal financing, then debt, then equity. Agency theory: debt can reduce agency costs, but increase monitoring costs. C. Optimal capital structure. An optimal structure minimizes WACC and maximizes firm value. Too much debt, high financial risk and interest burden. Too much equity, dilution of ownership and control. Factors affecting capital structure decisions. In this course, we will be using factor and impact in our table. First, business risk. Higher risk firms use less debt. Second, tax position. High tax firms benefit more from debt's tax shield. 3. Cash flow stability. Stable cash flows can handle debt obligations. 4. Company size and industry. Larger firms have access to capital markets. 5th, management attitude. Conservative managers prefer less debt. 6th, market conditions. Favorable equity markets encourage equity financing. 7. Regulatory framework. Legal limits on debt usage or equity requirements. Capital structure in practice, Nigeria and emerging markets. In economies like Nigeria, capital structure is often influenced by high interest rates and inflation, currency depreciation risks, access to credit markets, underdeveloped capital markets, exchange rate volatility, foreign investment availability. Thus, Nigerian firms often rely more on retained earnings or seek foreign equity partners. Capital restructuring and leveraging. Capital restructuring involves altering the debt-equity mix to improve financial performance. Leverage, the use of borrowed funds to increase potential returns. Operating leverage, fixed costs in operations. Financial leverage, use of debt in capital structure. High leverage equals high risk and high return potential. Application, capital structure and investment decision. Example, a company wants to raise 50 million naira. It can issue equity at 25% cost of capital, borrow at 15% interest with 30% tax. WACC scenarios can be evaluated to determine the best financing mix. The lower the WACC, the better for business valuation and growth. Summary and review. The cost of capital is the benchmark for investment decisions. WACC integrates both debt and equity costs into one figure. Capital structure decisions influence a firm's financial flexibility, risk, and profitability. The optimal capital structure balances risk and return. Local economic realities, especially in Nigeria, play a significant role in determining viable capital structures.